Hi, this is Mani from BSc to NSE.com. So in this video, I'm going to talk about what exactly futures trading is, because I know there are a lot of beginners who are still confused about what a futures trading is. So I assume that you would know that what buying a stock normally or buying a stock for delivery means. Normally we just buy shares of any company for like 5 to 10 days or maybe 6 months or a year and then sell it. So that's buying normally. So let's see what is the difference between buying a stock normally and buying a stock in futures. Okay, so um, almost all the stocks, I mean every stock can be bought for delivery, or you want to buy and hold it and then sell it whenever you want. But in futures, there's only select few stocks that can be traded in futures. There's only like 200 stocks, and most of them are large caps or mid caps. And this is decided by the exchange. Uh, and as the video goes on, you'll understand more of why these differences are there. And we'll come back to this differences slide again. So again, for delivery you can buy any number of shares. Let's say, for example, let's consider HCL Technologies in this video. For delivery, or if you're buying shares in delivery or normally, you can buy even 10 shares of HCL. You can buy even 2 shares of HCL. But in case of futures, you need to buy minimum one lot. And again, by the word lot, you can understand that a lot means a bunch of stocks. And in case of HCL, one lot consists of 500 shares of HCL. So you need to buy minimum one lot, meaning that you're actually buying 500 shares of HCL, or you're actually trading on 500 shares of HCL. So that is about futures. You'll need to buy minimum one lot, which is actually a lot of shares. And normally a lot value will be almost between 2 lakhs to 5 lakhs. And let's get to the next point. In case of delivery, you actually cannot sell shares without having it, meaning you'll need to buy HCL Technologies first, buy 10 shares of HCL Technologies, and then maybe after 2 months or 6 months or even a year or 2 years, you can sell the same 10 shares. So you cannot, you need to buy shares, hold them, and you can only sell shares which you're holding. So that's what it is in the case of delivery. But in case of futures, you can either buy or sell to start with. So there's no mandate like you need to have HCL before selling it in futures. So this is actually called as short trading, or here traders actually make money when the stock falls lower. So let's say you sell first and then the share goes down and then you buy it back. So that's how people gain by going short on a particular company. So that is possible in futures, wherein you need not buy first, you can just sell without having shares. And the next point, you can hold the shares for as long as you wish after you buy it, of course. So in case of delivery, I can buy the share today, I can sell it 20 years later, I can sell it 5 days later. Anything more than 2 days, you can sell it. After 2 days, it will get credited to your demat account. After that, you can sell it. But in case of futures, you need to exit on expiry. So normally you will have futures for the next 3 months, and each month has an individual contract. And On each month, the last Thursday will be the expiry. So if you're buying this month's contract, by end of this month you will have to sell it. Then you can jump to the next month and you can keep jumping over, but you'll need to buy and sell. The maximum holding period in case of futures, since only 3 months is available, is 90 days. So irrespective of whatever happens, the longest holding period in futures is only 90 days. So unlike in delivery, you cannot hold forever here. And the next point, in case of buying a stock normally, you actually need to pay fully, meaning let's say you're buying 10 shares of HCL, and let's assume HCL is 700 rupees today. So you'll need to pay 10 into 700, 7,000 rupees. You'll need to pay fully. But in case of futures, you will need to pay only a margin amount, meaning you need not pay fully. So we'll get to that later. In case of HCL, 500 shares at 700 rupees is almost 3.5 lakhs. But you would need a margin amount of only 60,000 to buy the 500 shares. So that is where you get higher leverage in futures, and that is where you can actually make more profits also. So it's also more risky being that way. Let's get to the next point. In case of delivery, the profit or loss is actually realized only when you sell it, meaning let's say you're buying 10 shares of HCL today at 700, and 2 years later the share goes to 1000 rupees. So the 300 rupees gain per share in HCL, you only realize it when you sell it, meaning when you sell it, the cash gets credited to your account. Either it's a profit or a loss, you only realize it when you sell it. But in case of futures, the concept is a little different, wherein every day, if it's a profit or a loss, if it's a profit, it gets credited in your account as cash, and if it's a loss, it gets debited from your account. So, and this is called as MTM, market to market, in futures. So in futures, be it profit or loss, every day the rise and fall or the profit or loss is credited and debited from your account. So in case you are unable to, in case your account runs into the negative, then you will be forced to exit your position in futures. So it's always a must that you have additional cash in your account, so that in case of any losses as the day goes on, you always need to be, your account always needs to be in the positive, so that you can hold a position in the futures. So let's now get to the a realistic data. Let's take the example of HCL Technologies. The symbol is HCL Tech, and the expiry date for the month of Jan in 2013 is 31st Jan. And the reason being, you can see in the calendar here, this is Jan 2013, and 31st is the last Thursday of the month. It also happens to be the last day of the month. Let's get to March, or let's get to March. In case of March contract, 28th, the last Thursday, will be the expiry for futures for all companies, not just HCL, for all companies. So this is what you see as expiry here, and the lot size for HCL is 500. And let's assume that today HCL is trading at 638. This is just an assumption. It's actually now trading at 700. And so 500 shares at 638 rupees, you multiply this both, 500 into 638, it's close to 3.2 lakhs. So this is the future value long, meaning the value of one lot of HCL Technologies in futures. And the margin required to buy one lot is 15%, meaning you need to have only 15% of 3.2 lakhs to buy HCL, one lot of HCL Technologies at 638 rupees. So the 15% on 3.2 lakhs is approximately 50,000. So this is the initial margin required whether you want to buy or sell HCL Technologies in futures market. So again, this data is available for all companies or all stocks that are traded in futures market. You should be able to get this data from your broker or demat service provider, and they'll have something like a futures margin list, and you can get this data for all stocks. So, and as the price of a stock varies, this will also change. The margin required and the lot value will also change, because when you multiply the number of shares into the share price, this thing changes. Now let's get to let's assume that today 19th Jan I am buying HCL at 638 rupees one lot, meaning I am buying 500 shares of HCL at 638 rupees, and let's assume that I am going to be holding it for the next 4 days. So let's assume HCL closes the day at 638 and you actually bought it at 638 also on 19th Jan, and let's assume that on 20th Jan it is closing at 648 rupees, 10 rupees higher a share on 20th Jan. So that means that you're essentially making a profit of 500 shares into 10 rupees is 5,000 rupees. So that will be the MTM that will get credited into your account at the end of the day on 20th Jan. So meaning if you had only the initial margin of 50k, at the end of 20th Jan your account will have 55k, out of which 50k would be blocked for margin for holding the position, and extra 5k cash would get credited onto your account. And on, let's say, the next day the markets crash and HCL also falls by 20 rupees. That means that on a daily basis HCL has gone down by 20 rupees per share. So your lot, which is having 500 shares of HCL, so essentially you are losing 10,000 rupees on that day. So 10,000 rupees would get debited from your account. Unless you have additional cash, I mean, you should have additional cash so that you can make sure that this debit does not make your account into run into negative balance. And let's assume the next day markets recover back nicely and HCL rises by 30 rupees, which means 30 rupees per share, meaning 500 shares you're holding, so for one lot. So 15,000 will get credited end of the day. And normally you can even sell, you can even buy the HCL futures contract morning 10 a.m. and sell it at a higher price 2 hours or 3 hours later, thereby doing intraday trading using futures. But let's assume HCL is a good company, and I expect HCL to get to around 900 by end of this year. So if you keep holding the contract and during expiry you exit the particular month contract and you switch to the next month, and you keep switching over for the next 12 months, you'll be gaining 300 rupees a share, assuming HCL gets to 938 by end of this year. If you keep holding futures, one lot of HCL futures for the whole year by switching over every month expiry, you will gain 500 into 300 rupees a share. That will essentially be profits of almost 1.5 lakhs. So the initial margin required is 50,000. You should have some additional cash, and this is actually from 600 to 900. It's only 50% rise in absolute returns. if you buy it for delivery, you'll gain only 50%, but in futures market your profits are becoming almost 150%. So that's actually 300%. So that's how much you gain by leveraging on futures. The same holds true also on the negative side, so the risk is equally there, so just make sure. And you can actually get back to this, you can look back at the differences, and now I think you can understand better. So just look at these, just pause the video here and look at these differences, and I'm sure you'll understand what futures trading is. So any queries, any questions, just post on this video, and any queries on futures trading, just post on this video and I'll get back to you. Thank you.